This is Satya Pradyuman of Cirrus Research. The latest issue of the Signals Report is just out. The Signals Report is a monthly asset allocation focused report. It looks at critical elements of positioning on portfolios. Number one, stocks versus bonds. Two, growth versus value. Larger cap versus smaller caps. In addition to that, market crowding and a few other elements. The title in this month's issue is Are You a Recessionist? And a little bit of tongue in cheek there, but the idea here is that within 3 days, we've gotten a massive turn in the markets as we entered August. And what we're now seeing is a potential, the talks of recession. What's curious about this is a lot of the fundamental data we're tracking just doesn't square with that. That said, one hiccup in the unemployment data on Friday of last week just seems to be too marginal to be able to move the needle in this. So the question is, what is going on? And in this title of this report, what we raise the question on is that really, are you a recessionist in the sense that have you been calling for a recession the last 2 years or so? Part of the reason we think there's a bias built into the outlook is that some of the critical tools in an outlook for the economy, namely the inverted yield curve, that signal has been triggering a recession for a few years. And we do think that in a world of volatile inflation, not disinflationary trends that are stable over 20, 30 years, or inflationary period that are actually quite high and stable for a long time. What we've got here in the last few years is a much more volatile environment with shutdown, reopening, supply chain. These elements have driven the inflation data to be quite volatile. As a result, we think that yield curve indicator offers up a ton of false positives. Importantly, when we look at the stocks versus bond allocation, that valuation model just went up from a 53% allocation to a 68% equity allocation. In other words, risk assets still are favorable. You've got a profit cycle that's favorable that allows for investors to look to equities for growth. We are in the early phases of a bottoming in the profit cycle. So if you couple that with a central bank that's likely to ease or continue to ease as we've seen overseas, these are very good things for equity valuations. Importantly, what we think may be underneath this really tumultuous period, because we don't deny that this is a fragile equity markets backdrop. That said, what we could be dealing with here is a break in leadership instead of a recession trade. Really important to understand the difference. Take a look at the full report, and as always, happy to take your questions. Thank you.